Leverage is probably the number one benefit of property. I say this time and time again, you can use other people's money to invest. Now, if you start out with a $100,000 investment, if you've got $100,000 worth of cash, you can invest it in shares, cash, in the bank, managed funds, whatever. And anything like cash or managed funds is going to get you a lesser return than property, generally speaking. Shares gets you a greater. But you've got the ability to go to the bank and borrow some money as well. So banks will give you 80% for every 20% you put in, or $4 for every dollar that you put in at today's ratios. Now, that $100,000 investment quickly becomes a $500,000 investment if you're getting $400,000 from the bank. Now, the best part about that is you keep all of the growth on all of that money. You've got to pay the interest, but tenants pay that as well. And that's another form of leverage as well. You've got the tenants' money coming in to pay the mortgage, you've got the bank's money to invest. And so whilst you might not get as high a percentage as shares, you get a much higher output because of the fact that you're using other people's money. I guess property for me is just such a tried and true investment. It's not property itself, it's about the numbers for me when I look at any investment. And you've got something there that's tangible, which I really like. You've got the ability to leverage. People understand it. And so I do love property, but not because it's property, because it's just tried and true. Working up the risk profile, I guess. So if you start with cash or money in the bank or term deposits, generally speaking at the moment, you might get about 2% before tax. If you're investing in, say, a managed fund, it might be 4%. If you're investing in property, we generally say 5 or 6%, depending on where you're buying. And if you're investing in shares, generally speaking, we'd work on maybe a 10% return. In our last lesson, we spoke a little bit about setting big goals for your financial future. And we talked about people maybe needing to save $3 or $4 million. Now, if we just use an example of someone wanting $1 million in 20 years' time, then based on today's interest rate of say 2%, you need to be saving about $800 a week, and that's just not achievable for most people. Most people don't have $800 spare at the end of the week once they've paid all their bills, and even if they do, it's a very inefficient way of getting ahead, given inflation could be 2 or 3%. So you need to do something more, and you need to be using something like leverage, using the assets that you've currently got to supercharge your investment through things like property. Most people are sitting on a gold mine because they've got a house that they're paying down a mortgage, and they've got this thing called equity, which is the difference between the value and the mortgage that they owe on it. Now, within that, there's a whole lot of dead equity that you're not using for investment. And whilst your house gives you somewhere to live, it's not an asset in the true sense of the word because it's not generating an income. Most people have a whole lot of usable equity or dead money in their own house. So let's use an example of someone with a house worth $500,000 and a mortgage of say $200,000. So they've got $300,000 worth of equity. That's their part of the house, that's their money. Now, you can't use all of that, but a bank, generally speaking, might lend you up to 80% of the value of your house. So 80% of a $500,000 asset is $400,000. That's your bank value. Now, minus your mortgage from that, so 400 minus 200, that 200,000 difference is your usable equity. So if you don't have a cash deposit, you can use some of that usable equity to form that deposit. So if you've got 200,000 worth of usable equity, and if the bank rules stay the same of 20% deposit required for an investment property, that gives you $1 million worth of purchasing power for any future investments. So if you are borrowing 100% of that usable equity and going and buying $1 million worth of rental properties, then there'd be 200,000 against your house, and there'd be 800,000 against the new investment properties. So when we look at it over a 15-year period, your return on a term deposit is about $35,000. If it's something like a bond or a debenture or a managed fund at 4%, that's $80,000. If it's shares, it works out to be about $340,000. But property, again, if it's leveraged, works out to be about $540,000 return. So it's much, much higher.